Hello everyone, it is Bryan of Asante Capital Management, and today I wanted to talk about the optimal investment strategy. Unless your home team wins the championship, headlines are typically negative. This helps capture our attention and keeps our eyeballs glued to our screens. We know this. What's remarkable to me is how quickly the media moves from one crisis to the next. Over the last 6 months, for example, we've shuffled from the COVID crisis to the Russian aggression crisis and now to the cost of living crisis. I'm not suggesting that these events aren't real or impactful on people. I'm suggesting that we don't get a day off and that we are rarely informed of how we successfully exited previous challenges. Today, the bubbling crisis seems to be that of the coming recession. Will there be a recession in the future? Absolutely. Will it begin in 6 months, 24 months, or in 5 years? I don't know the timing, nor does anybody else with complete certainty. For your portfolio, this matters because equity markets tend to retrench when a recession is on the horizon and climb when expansion is within sight. The formula seems straightforward and easy to take advantage of. Unfortunately, no one has successfully predicted the start and end of a recession in any consistent manner. That's why financial commentators generally assign a probability, like a 27% chance of recession in the next 12 months. And supposing someone could make that prediction, they would then need to determine when the markets would react negatively to the coming recession and positively react to the pending expansion. Those are two dimensions of extreme complexity, overlapping each other. Bonne chance. I often cite examples of how trying to time the market leads to poor results. I stumbled on a gem the other day. Fidelity conducted an analysis of their clients to determine what subgroup had the best performance between 2003 and 2013. They learned that those with the best returns were either dead or inactive. That's right, dead or inactive. And what do these two groups have in common? They don't react. They don't react to today's hype or panic. But know that your portfolio is not on autopilot. Your portfolio managers are making proactive changes behind the scenes. Perhaps they're holding a little bit more cash than usual. Perhaps they've exited or entered certain sectors or geographies. Or maybe they've purchased some amount of portfolio insurance. Their intention is to make any downside less severe rather than avoid the recession bogey entirely. Well, why not try and avoid it? Well, as I've said before, nobody can do this with certainty because we're looking at an economy, the US economy as an example, that grows 85% of the time. And we have markets that rise 3 out of every 4 years. It does not make sense to fight the gravitational pull upwards. It does not. I am encouraged that all of you exemplify these positive investment traits while still being alive and active. Congratulations. I hope you are all well, and if you have any questions, please give me a call.